What's up everybody? GenExDividendInvestor here. If you're new to my channel, then welcome. In this video I'll show you what I feel the best bank dividend stocks are, and I'll share what prices I would buy them at, along with the prices analysts have them at, as a way to help you identify some potentially cheap stocks in today's hot market. I'll also tell you the amazing true story about a gas station attendant turned janitor who invested his way to a net worth of $8 million from dividend stocks. A story flush with investing lessons that you could utilize to become wealthy, even if you're broke right now. Please consider this video as entertainment and not financial advice, and don't forget to nail that thumbs up button, subscribe if you haven't yet, and click that bell notification. So I was going to make this video about all the financial stocks, but financials are so broad I decided to just focus on banks, and then maybe later I'll do one for insurance companies, one for mortgage REITs, one for diversified financials, whatever. These days, another category of stocks that spans both financials and technology is fintech, though that's not formally recognized per the Global Industry Classification Standard. For reference, the 11 stock sectors are energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. Let's look at how the financial sector as a whole has been doing in the last 5 years compared to other sectors into the S&P 500. We see that the S&P 500 has had a total return of 110%, whereas the financial sector has been slightly underperforming, returning about 93% over that same time frame. The best sector has been tech at 239%. Energy has been the lowest at minus 31%, but has been doing well lately, and if the vaccines keep working, it's plausible to think that trend might continue. If you want to invest in the financial sector as a whole, you could consider ticker XLF, which is the Financial Select Sector Spider Fund. Or if you're a Vanguard fan, you could consider VFH, the Vanguard Financials ETF. And for reference, financials represents about 11% of the S&P 500, but it's only about 4% of my dividend portfolio. Using Dividend Channel's Total Return Strip Calculator, we see that if you invested about 23 years ago when XLF was formed, then you would have seen a 5% annualized return, which underperforms SPY's 7.75%. I read that the average annual return of the S&P 500 since its inception in 1926 through 2018 is approximately 10%, but since 1957 it's only been 8%, not counting inflation. Now as I go through the stocks, I'm going to share my estimate for what I think their one-year fair values will be, based on their prior financial metrics along with growth estimates. Here's a picture I made to show you my perspective on how stock prices and their intrinsic values often work. Usually what you see is that as earnings go up, then stock prices go up. The purplish blue line represents the intrinsic value of a company, which in this case I call my target price, a price which changes over time based on earnings and such, and which tends to act like gravity or a magnet trying to pull the black line, which is the stock price at a point in time, towards it. Stock prices in the short term are overly influenced by news headlines and market events, and ultimately people's emotions. Thus they can easily break the pull of the purple line and go wherever, but over time stock prices tend to eventually trend towards the real intrinsic value of a company, which is why you want companies that keep growing. In this example stock price picture, you can see an intrinsic value estimation of a random company, which goes up and down as time goes on, but is slowly trending up, like most qualities companies tend to do over long periods of time. The ideal time to buy a stock is when it's underpriced, which is represented as areas of red where the stock price fluctuates under its intrinsic value price. Now, if your strategy is to buy and hold for generations, then buying at any stock price can work out, it's just that your returns will be less than if you buy when something is on sale. And regardless of when you buy, it's always possible that you can lose money in the markets. Similarly, the better time to sell a stock is when it's overpriced, aka higher than its intrinsic value, which is generally any period on this graph along the areas of green. This example picture could represent 20 years of stock prices, so you need to understand that something could be underpriced for years or overpriced for years. But in my experience, stocks eventually tend to drive towards their real intrinsic values, which you can calculate with discounted cash flow calculations, and which I've also found useful to estimate using price to earning trends. Finally, I wanted to share that I'm including some Canadian banks in this list, and SimplySafeDividends.com has a blurb that I thought would be useful about how Canadian banks pay their dividends in Canadian dollars, which creates some currency risk in that a stronger US dollar might decrease the effective dividend amount for American shareholders, as each quarterly dividend is converted from Canadian dollars to US dollars when it's paid, based on prevailing exchange rates. So in my words, that means that it's possible that even though they increase their dividend each year in Canadian dollars, when it's converted to US dollars, it could effectively be a dividend cut due to a lower payout. In addition, like all Canadian stocks, US investors may face a 15% foreign dividend tax withholding requirement, which I think could be claimed as a tax credit with the IRS and apparently is waived if the stock is being held in US retirement accounts. So TLDR, there may be some tax complexity to deal with. Anyways, when you're analyzing banks, you want to understand a variety of things. Like, is it a commercial bank that primarily makes money by lending money to customers and then profiting on their interest margin? Or are they an investment bank that advises their clients on financial matters? Or do they do both of those things? Understanding a bank's interest income can be a good measure to dig into to see how much income is being generated by their savings accounts, CDs, etc. And of course, as customers pay down their loans, then interest income declines. When you're reviewing bank balance sheets, you should understand what percentage of their assets are loans versus whatever, and compare that to their peers and their trends. It's also good to understand what sorts of loans banks are involved with. Mortgage, auto, business, knowing those sorts of things might influence your investing decision. It can be helpful to understand what liabilities banks carry as part of understanding their risk profile. Deposits you put into the bank are considered liabilities as you are effectively lending the bank money so they can do something with it. Understanding a bank's revenue from mortgage fees or late fees or payment processing or whatever is also useful. Most people like to use a PB ratio or a price-to-book ratio to help them value a bank more so than a PE ratio. A PB provides some insights into the efficiency with which a bank's funds are used, which is important for a bank's success. Speaking of efficiency, a bank's efficiency ratio tells you how efficiently a bank is running its operations. An efficiency ratio of 65% means a bank is paying 65 cents for every $1 it makes in revenue. So the lower the efficiency ratio, the better. Going back to price to books, PBs paint a picture for how a bank is doing, even if losses are happening. If a bank is losing money, then the price to earnings ratio is not too useful. PBs also help you understand the bank spread, which is the difference between the interest rate that a bank charges a borrower and the interest rate a bank pays a depositor. This spread percentage tells you how much money the bank is earning versus how much it gives back. Another financial metric that is useful to understand with banks is their return on equity, aka ROE, which shows you how a bank turns its equity into earnings, and generally speaking, an ROE over 10% is good and more is better. Understanding a bank's net interest margin is also useful as it measures how profitably a bank is making investments, and the higher the better. Return on assets, or ROA, is another one, which is an indicator of how well a company utilizes its assets in terms of profitability, and I like to see over a 1% for banks. It's also good to understand a bank's risks, like how much risk a bank is taking on to achieve its earnings is important. Understanding their bad loan percentage, aka non-performing loans to total loans, is also important. Non-performing loans are loans that are behind on payment based on a certain amount of time, like 90 days. Obviously, those are bad, and the more they have, the more risk the bank is taking on. When you're looking at a bank's metrics, it's also useful to understand the overall macroeconomic climate they are operating in, as well as how their peers are doing. Anyways, that's a bird's eye view of things, but if you really want to dive into banks, then there are lots of other useful metrics to trend and compare, like loan-to-deposit ratios, capital ratios, etc. Okay, let's dive into a new spreadsheet I made about the stocks, using a few important metrics, though I urge you to dig deeper if you want to invest. Okay, here we are in a new spreadsheet I made about the various banks, and here are the ones which didn't make it into the top 3. And so you can see Bank of America, Citigroup, Wells Fargo, US Bancorp, Truist Financial, PNC Financial Services, Bank of New York Mellon, and Capital One Financial Corp. I also have their current stock price, my 1-year fair value estimate for them, and the percentage that my target price is relative to today's price. Then I also included what the Wall Street analysts have as a target price and what their percentage is. Then I have the number of consecutive years of dividend increases based on DividendInvestor.com, and anything that's greater than or equal to 9 years I highlighted in green. Then I list their dividend yield, and anything that's greater than or equal to 3% I highlight in green. And then I have their 5-year dividend CAGR from Seeking Alpha, and highlight anything that's greater than or equal to a 10% dividend CAGR. If you see a negative number, it means they had a dividend cut over that time frame. Payout ratio. Then we have the 5-year annualized return from Dividend Channel, and the market's returned around an 18%, so anything above that is highlighted in green. And then a 20-year annualized return where the market returned 9.25%, and in this case, none of these companies beat the markets. And then we have the analyst rating in terms of buy, sell, hold. And then I included the total assets, the total liabilities, so it's good to compare those. The PE, the price to book, profitability, ROA, and anything greater than or equal to 1% I highlight in green. And then the profitability ROE, where anything greater than or equal to 10% I highlight in green. And then if we go up to the ones here, you can see that all of these I tied for third. They're actually all Canadian banks. And you can see some of my targets. I'll include the spreadsheet if you'd like a copy of it. Just go to File, make a copy, and get your own copy of it. Pretty much all the best banks have about 9 to 10 years of consecutive dividend increases, which kind of harkens back to the 2008 financial crisis. What's really nice about the Canadian banks is they have a really high yield. I mean, 3.83%, 4.61%, high relatively speaking, 3.99%. So higher yield, lower CAGRs on average, which is kind of what you'd expect. Good payout ratios. You can see that none of them beat the 5-year returns, so I don't like to see that. But they all beat the 20-year annualized returns, which is great. And you can see some of their other metrics here. And then number 2 is Goldman Sachs. You can see the various numbers here. Now they've got a very low yield, but a very nice CAGR, which is kind of what you'd expect. As yield goes down, then they tend to do increases more. Here they did a great job of both beating the market in 5 years and beating the market over 20 years. So that's great. And you can see all their other metrics. ROA looks great and ROE looks great. And then the number 1 is JPMorgan Chase, which I own. You can see what my targets are and the analyst targets. They're at 10 years. And you can see their dividend yield, nice CAGR. Their payout ratio, and again, Goldman Sachs and JPMorgan Chase are the only 2 companies that both beat the market's 5-year overall returns and 20-year returns. See their assets to liabilities, PE, PB, nice profitability, return on assets, and nice profitability, return on equity. Okay, here we are in my dividend portfolio tracking spreadsheet in the stock comparison tool. And we can put in JPM and Goldman Sachs. And then it gives you a description of each one. And then down here, it's highlighted in green as a comparison to the other side if it's a better metric. So for example, this payout ratio is 9% on Goldman Sachs versus 24% on JPMorgan. So this one's highlighted in green. And then if we look down here, we can kind of see how their stock prices have been trending. We can see how their dividend payouts have trended, how dividend yields has trended. So it looks like Goldman Sachs is becoming a little bit more compelling, faster. We can see their quarterly EPS growth, and we can see their shares outstanding. So if we look at this trend, we see that Goldman Sachs is being more aggressive on the share buybacks. And we look at their assets to liabilities, and we see that both of them have more assets than their liabilities, and they're both growing at a faster rate. Here we can see their quarterly revenue. Looks like JPM is trending up better. And here's the quarterly net income with, again, JPM has a better trend. Price to free cash flow ratio, so in this case, Goldman Sachs looks a bit more compelling. And then we can see from a debt perspective. So it's a quick at-a-glance way to compare 2 stocks. Okay, hopefully that review will help you identify some new stocks for your dividend portfolio. Speaking of portfolios, M1 currently has a referral bonus promotion of a free $30 when you open an account per their requirements. I'm not sure what they'll be paying out, if anything, when you watch this video, but historically it's been between $10 and $50, so check the link for details. The way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500, deposits which need to happen within 30 days of you opening the account. Then you need to keep your initial deposit inside the new account for 30 days from the date of deposit to get however much they're offering. Now I want to tell you the story of Ronald Reed, a normal blue-collar guy that grew his net worth to almost 8 figures due to his dividend stock investments. I thought I had actually told Ronald's story already, but then multiple subscribers asked me to share it, so I guess I didn't. Ronald Reed grew up in a poor farming household in Vermont in the 1920s. When he was around 10 years old, the Great Depression hit, and it was the longest, deepest, and most widespread depression of the 20th century. It started in the US after we had a major stock market crash which utterly wiped out millions of investors. Unemployment in the US rose to 23% and hit 33% in some other countries. That was the world Ronald grew up in. His high school was 4 miles away from where he lived, so he did a lot of walking back and forth from school in order to become educated, and he ended up being the first member of his family to get a diploma. Then World War II started, so he enlisted in the army. After his deployment was over, he traveled back home and then worked for multiple decades at a gas station. He later worked at JCPenney for another 20 years as a janitor. None of Ronald's friends or family knew that he had any real money because he lived a very frugal, no-frills lifestyle. They knew he was investing though, as he read the Wall Street Journal every day and he went to the library to research stocks. Apparently he liked seeing dividend checks arrive in the mail, and he was known to then deposit those checks and use the cash to buy even more shares. When he died, his lawyer said, quote, "He only invested in what he knew and what paid dividends." They did an analysis on his accounts and they figured out that he started investing when he turned 37 years old. Some of his companies went bankrupt over the years, but due to having a number of diversified companies, he wasn't overly impacted. He just kept investing and compounding. He invested for over 50 years, slowly and regularly putting money into quality blue-chip companies that paid dividends, including many I own like Procter & Gamble, Colgate-Palmolive, J&J, and JPMorgan Chase. He owned railroads, banks, credit card companies, industrials, etc. Multiple times he saw his portfolio value decline by 50% or more on paper, but he just kept investing through multiple wars, inflation, deflation, tax changes. It didn't matter, he just kept slowly moving forward. He understood the risks of constantly trading into and out of stocks, and he understood the advantage of deferred taxes. He didn't invest in tech companies because he didn't understand them and because most didn't pay a dividend. He was a true buy and hold investor. When he died, his estate was worth around $8 million, mostly all stock. He left about $2 million to his friends and relatives, $5 million to a hospital, and over $1 million to a library. So what lessons can you learn from him? Number 1, live frugally. You don't need to be showy, nor do you need to keep raising your lifestyle just because you have more. Live like Warren Buffett, not like Floyd Mayweather. Number 2, research before you invest and know what you're investing in. Number 3, have a diverse portfolio so if one of your company's tanks, it doesn't impact you too much. Number 4, it's never too late to start investing and go on a better path. Number 5, invest for the remainder of your life through good markets and bad ones. Number 6, you don't need a huge salary to become wealthy. Small investments over decades of time is life-changing. Number 7, stay patient. Don't constantly get in and out of positions. Number 8, keep reinvesting those dividends. Number 9, it's hard to beat the long-term returns of the US stock market. I say long-term because over short periods of time, other asset classes have temporarily done better. This inflation-adjusted chart created by Deutsche Bank shows historical returns for US stocks, bonds, and commodities like gold. Now this chart doesn't include crypto, which has been the winner, generally speaking, over the last decade, so it'll be fun to see how it holds up over multiple decades. Productive assets, i.e. companies which are constantly innovating and growing and evolving, have always outperformed store value assets like gold as time goes on. And remember, compounding in time is magic, as you saw what it did for Ronald. Now that asset returns data I showed you is historical, and it's possible the future will be different. Some people say that they don't believe that the US stock market will keep growing. They think the best days of innovation are behind us. While I recognize anything is possible, I think that the pace of worldwide innovation is going to keep increasing, which will be a catalyst for companies to continue growing and prospering. The internet is low barrier to entry for people around the world to build new things. Beyond the internet, AI might usher in a new era of growth and prosperity. Sure, I think we'll have periods of downtimes and occasionally things will look bleak, but I don't think that any of us can truly understand the power of what AI will do, and I for one want to be investing in companies that are winning the AI race, and I bet that some of the companies I invest in, like Microsoft, Apple, Google, Tesla, and Amazon, will remain as tech leaders when real AI comes along. Now I'd like to shout out my latest Patreon supporter, SH4132, who just upgraded his membership from the Champion tier to the Aristocrat tier. I asked SH4132 how he got his handle, and he said that 41 was his basketball number in high school and 32 was his best friend's. Anyways, as a Patreon aristocrat, SH4132 gains access to my dividend portfolio tracker spreadsheet tool I used in this video, along with he gained access to multiple private channels on my Discord, including one where I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails I use for my new videos. If you made it to this point in the video, I ask you to please slam that thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching and hitting that thumbs up button, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.